Thank you, Amy, and thank you all for joining today. I'm going to be talking for about 45, 50 minutes, and I think Amy has some closing comments as well, just to give you a time frame on it. So I've written 5 books on retirement. My first book is a book by the name of Paychecks and Playchecks, and I will tell you, I'm a reluctant author. I never want to write a book. I didn't dream of writing a book. It wasn't on my bucket list. So why'd I write a book? Well, here's why. Because right now, if your clients talk to 50 different financial advisors and ask this very simple question, how should I retire, or what should my retirement portfolio look like? You know what they're going to get? They're going to get 50 different opinions of what they ought to do. Well, see, retirement's been studied in depth by PhDs all over the world. People like Dr. David Babbel of Wharton, Dr. Moshe Milevsky of Toronto, Dr. Menachem Yari of Israel, Dr. Wade Pfau, Dr. Michael Finke, Nobel Prize winners like Dr. William Sharp and Dr. Robert C. Merton. Well, guess what? I've read the research. You know what the research says? There are not 50 optimal ways to retire. There's really one optimal way to retire, and that's not my opinion. It's based on mathematical, scientific, and economic facts. So what I'm not going to do today is give you a bunch of my opinions. What I am going to do is lay out the math and science behind a successful retirement. I also want to tell you, I don't sell any annuities. I don't sell any financial products whatsoever. I don't get compensated on the sale of any financial products, okay? And I don't work for any one company. I get hired by most of the Fortune 500 insurance and investment companies to do 2 simple things. Number 1, I train financial advisors. And number 2, I do public seminars and public webinars for people's clients and prospects, all right? Now, I can tell you the day I decided to write the book. The day was April 4th of 2011. At the time, I was a senior executive officer at New York Life. I woke up that morning, minding my own business, reading the Wall Street Journal, when this headline popped out: Fed's low interest rates crack retirees' nest eggs. And this article is all about a guy by the name of Forrest Yeager, 91 years of age, down in Port Charlotte, Florida, down to his last $45,000. He had it sitting in a CD earning about 1%. He said, I'm not going to make it. I'm having to take money out of my portfolio, and I'm going to run out of money. And I'm reading this. I want to say, Forrest, you're 91. Did you know a 91-year-old can walk into almost any insurance company in America today and buy a SPIA, a single premium immediate annuity? Do you know what the guaranteed payout rate, guaranteed on a 91-year-old is? 20% a year. His $45,000 would have guaranteed him $9,000 every year for the rest of his life. He would have never run out of money. But Forrest didn't know. There were other people in this article. They're in their 50s and 60s. They got their money in the market. The market's crashing. They're freaking out. They don't know what to do. I said, okay, I got to write a book. So I wrote a book on how to retire the optimal way, based in math and science, not based on some stockbroker's opinion. And the first chapter is simply titled, Whatever Happened to Happily Ever After? You know, you read those stories to your kids and grandkids. What happens at the end of every story? Everybody magically lives happily ever after.
And pardon my interruption, Tom. I think our users are having a little bit of trouble understanding. I think there might be a slight mic issue. There's just some distortion coming through.
Let me just take a peek on this. I mean, this microphone's been working great for months. So
that already sounds a bit better. Maybe it was too close or something.
All right. Well, I'll keep trying. If it's bad, just wave at me or something.
Much better now. Thank you.
So the first chapter is titled "Whatever Happened to Happily Ever After," because you read those stories, your kids and grandkids, everybody magically lives happily ever after. Well, retirement in America used to be just like that. Retirement used to be a promise. You know, you'd work for a company for 30 or 40 years. Then what? They'd hold a party. Then what? They'd present you with a gold watch. Then what? They'd give you a guaranteed paycheck every single month for the rest of your life in the form of a pension so that you too could live happily ever after. Well, what happened to that deal? You know, there's only 6% of Americans have that pension, and it's coming at a time when people need guaranteed lifetime income more than ever. There's 78 million baby boomers heading straight into retirement. They need guaranteed lifetime income more than ever, and they don't have it. Add to the fact that people are living longer. The average 65-year-old male will live to be age 86. The average 65-year-old female will live to be age 89. But what's the problem with averages? That has nothing to do with how long you're going to live. See, half of the people on this call are going to live longer than that, because if you study life expectancy the way I've studied life expectancy, you're going to figure this out real quick. Life expectancy is not an average at all. Life expectancy is simply a midpoint. All life expectancy means is that half of the 65-year-old men will die prior to age 86. What about the other half? Half of the 65-year-old women will die prior to age 89. What about the other half? See, they're all still alive. And here's another fact. Married people live longer than single people. I have no idea why, but it's a fact. So you can see here, his life expectancy is age 86. Her life expectancy is age 89. But as a couple, their life expectancy is age 93. 50% of all 65-year-old couples will have somebody live to be 93. 25% of those couples will have somebody live to be 97. And there will be plenty of people on this call who live beyond age 100. So the first key concept I want to make clear is this. When you're planning for income for your clients, you've got to give them income to age 100 and beyond. The other thing is people know how much money they have. I could prove it to you right now. I could have each one of you jot down on a piece of paper how much have you been able to save from birth until today. And I'll bet every one of you could get that number within what, 500,000 or 600,000 of the real number, right? So you all know how much money you have. It's just that most people don't have a good idea what they can expect from that money. They say things like this. Well, the stock market's averaged 12% a year since 1924. So certainly I could take out 10 or 12%. No, you can't. You know, for years they said 4% was a safe withdrawal rate. Now Morningstar says it's 3.4%. Dr. Wade Faust says it's 2.8%. So you can't take out 7 or 8 or 10% because of this thing called a sequence or order of returns. So what I'm going to do is I'm going to shake the ladder a little bit. I want to challenge your thinking. I want to show you some things you haven't seen before, maybe in a way you haven't seen. And I'm going to start right here. The day you retire and start taking money out of a portfolio, all the investment rules you thought you knew go out the window. They mean nothing. Now, what do I mean by that? Well, your entire life as a saver and investor, there's only one thing that's mattered, and that's been your average return. I mean, if you get 10%, it's better than 8. If you get 12%, it's better than 10. If you get 14%, it's better than 12. Your entire life as a saver and investor was focused on average returns. And yet the day you retire and start taking money out of a portfolio, average returns mean nothing. There's only one thing that matters once you retire, and that's called the order or sequence of returns. So let me try to show this to you. Here's a guy in 1973, and by the way, I picked 73 and 95 because those are about 22 years where the market went up and down. So it's not like these are old numbers. These are just showing the concept, okay? Here's a guy in 1973. He had $100,000. He invested his money 50% stock, 50% bonds. For the next 22 years, he averaged 10.1% a year, and his $100,000 grew to be worth $846,000. And it doesn't matter if we ran the numbers backwards from 1995 to 1973. Why? Because he still averaged 10.1% a year for 22 years. He still wound up with a lot of money. See, that's the way stockbrokers think the market works. That's the way most of your clients think the stock market works, and that is how it works when you're a saver and an investor. But that is not how it works the day you retire. The next slide I'm going to show you is a guy who retired in 1973. He also had $100,000. He also invested 50% stock, 50% bonds. He also averaged 10.1% a year for 22 years. But his broker told him he could take out 5% per year. Well, come on. If you average 10.1% a year for 22 years, you could certainly take out 5% a year, right? Wrong. He's dead broke. He completely ran out of money. Now, how do you do that? How can you average 10%, only take out 5%, and go dead broke? It's because of this thing called the order or sequence of returns. If you look at that orange line, what happened the first couple of years of the stock market? It went down, down, down. See, here's what math and science says. If you're taking money out of a portfolio, and the first couple of years of your retirement, the market goes down, 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 you are highly likely to run out of money. Conversely, the black line, the market was flat or went up, up, up. If you retire and you're taking money out of a portfolio, in the first few years, the market goes up, up, up. Math and science says you are highly likely to be successful. The problem is none of us knows those years when the market's up or down. And the only difference between the orange line and the black line there was luck. Good luck or bad luck. It had nothing to do with who your investment advisor was, what you were invested in. It didn't matter. It was bad luck. And you don't want to have your retirement determined by bad luck. This is another way of showing it to you. And this is going to go against everything you've always been taught. You know how I know? Because it goes against everything I was always taught. See, I was always taught the older you are, the more conservative you should invest. I was taught that 80-year-olds should invest their money more conservative than 60-year-olds, and 60-year-olds should invest their money more conservative than 40-year-olds. That's what I was taught. I'm sure you were taught that too. That's not what this shows. Both of these portfolios have identical average returns. Identical. What's the only difference? The only difference is the red portfolio lost money early in retirement. It devastated their retirement. The blue portfolio lost money later in life and had much less of an impact. So if you had to say to me, Tom, when is the riskiest time for me to invest my money? It's not when you're 87. It's when you're 57 to 67. See, if you want to pick a time in your life where you don't want to lose money, you don't want to lose money right before or right after retirement. Why? Because if you lose money in that box, it can devastate your whole retirement. So here's a question for you. Where are those 78 million baby boomers we were talking about? They're all in the box. This is why you've got to put guarantees into those baby boomers portfolios, because if they lose money, and right now, market's near all-time record highs, now the Fed's starting to raise rates, markets getting a little shaky. If that thing went down and stayed down for 5 or 10 or 15 years, that would ruin the retirements of millions and millions of baby boomers. And then inflation, inflation was dead for 40 years. It's not dead anymore. And it can have a dramatic negative impact on purchasing power. This shows $1,000 of purchasing power at 4% inflation will be cut by more than 50% in 20 years. It'll be cut by more than 2/3 in 30 years. So when you're giving your clients income in retirement, you can't just give them income. You got to figure out how you're going to give them increasing income for the rest of their life. Now, there's several ways to do that. You can do what I do. I own 11 annuities. Dr. David Babel, who's in this book, he's got 14 annuities. All right. So I've got some that kick in when I turn age 60. I got some that kick in when I'm 62, 65, 70. I am guaranteed to have increasing income for the rest of my life, and your clients can do that as well. They can also invest here in a portfolio of stocks and commodities and real estate. You can build a portfolio that if we get inflation, the portfolio goes up and there's more money to take out more money. But however they do it, they've got to have a plan for inflation to have increasing income. So, all right. A lot of risks in retirement. There's market risk. There's withdrawal rate risk. You take out too much, you'll run out. That order of returns risk at the bottom left. They're going to raise your taxes. And by the way, this is not a Republican or Democrat issue. Okay, this is a math problem. We're $30 trillion in debt, climbing at $4 billion every single morning. We have $200 trillion of unfunded obligation for Social Security, Medicare, Medicaid, government pensions, military pensions. Taxes have to go up a lot. I have been moving more of my personal wealth to cash value life insurance because I want to have sources of tax-free income. I've converted almost all of my IRAs and 401ks to Roth, and most of those are in income annuities. So those are going to give me tax-free income for the rest of my life. The more tax-free income you can build up for your clients in retirement, the better they're going to be. Inflation, you got to protect against that. You might need long-term care. You might die. There are a lot of risks in retirement, but there's only one number one risk. So take a look at that list. Which of those risks is hands down? Nothing's even close. The number one risk in retirement is longevity risk. But why? It's because it's not just a risk. It's a risk multiplier of all the other risks. See, the longer you live, the more likely the market will crash. The longer you live, the more likely you'll take out too much money. The longer you live, the more likely you'll see inflation, the more likely they'll raise your taxes, the more likely you're going to need long-term care. And so with the PhDs who've studied retirement, and they are unanimous saying this, to retire optimally, you must take longevity risk off the table. In fact, if you get nothing else out of my first 20 minutes, get that. You must take longevity risk off the table. Well, guess what? Stocks can't do that. Bonds can't do that. Real estate can't do that. Crypto cannot do it. Okay, well, what can do it? It's a pretty short list. A lifetime income annuity can do it. A deferred income annuity can do it. Or an income withdrawal benefit rider from a fixed index, or variable annuity can do it. That is it. What do all those products have in common? One word, annuity. What all the research I can find from the smartest PhDs in the world who study retirement says this: to retire optimally, you must put an annuity into that portfolio. Why? Because only an annuity can take longevity risk off the table. Why? Because only a life insurance company can issue an annuity. Why? Because only a life insurance company sells life insurance to be on the other side of that risk. See, the risk when they sell life insurance is that somebody dies too soon. The risk when they sell an annuity is that somebody lives too long. Because they're on both sides of that risk, they can neutralize mortality and longevity risk to themselves and to your clients.